Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
David Morgan is our guest. He's an expert on the silver market. You can find him at silver-investor.com, home of the Morgan Report, and he's also on Twitter. You can follow him at SilverGuru22. Hey, David, it's good to have you back.
Phil, it's great to be back with you.
You're just back from Hong Kong. What were you doing there, and what was going on?
Well, it was a huge conference sponsored by Standard Chartered Bank, and they are one of the biggest banks in Asia, or if not the biggest bank in Asia. And the whole conference centered around the resource sector, and basically the theme was that the best place to put your money is in the resource sector. And they had, soup to nuts, meaning they had everything from the precious metals, base metals, energies going from natural gas, coal, shale, oil, conventional, and on out into the rare earth elements. So they basically covered the gamut in the natural resource sectors. And again, the theme was being that this is where real wealth is. This is what you should be focused on, and all kinds of presentations presented by companies. And then there were a few keynote speakers, me being one of them, that talked about the big picture and why this commodities boom is going to continue and why it's so important.
Now, you've been talking about this for a while, and normally we see these things put on by the companies themselves or private operations, but it's interesting to hear a bank presenting this kind of thing.
Absolutely. In fact, when I was asked to speak, I told the host, I'm not that pro fractional reserve banking, and usually I'm a gentleman all the way, but nonetheless I speak my mind, and I'm not going to change for this conference. And I kind of gave him a few quick quips of what I normally have to say, and he just started laughing and said, "That's fine, that's what we want.
Yeah.
We want the controversy, if you want to call it that, but basically what it was implying was that we want to emphasize that don't hold your cash, put it into real assets." And I thought that was interesting coming from a bank, but that's sort of the Asian mindset.
Yeah.
Because as we both know, Phil, and I'm sure most of our listeners, is that China has this huge balance of trade surplus, and they get all of these U.S. dollars that we keep borrowing to maintain our lifestyle, and China's got a dollar problem. Well, the dollar problem is solved pretty much by going into Africa and Brazil and all over the world, basically, and buying up mineral resources, energy resources, and that type of thing globally, because they understand that dollars depreciate as much as anybody understands it. So that's the basic theme. The bank, the biggest bank in Asia, is emphasizing that theme. And the shift, the macro shift that I talked about in my lecture, is that the wealth is, the mainstay of wealth is moving from North America toward Asia. In other words, the Asian countries on whole are getting wealthier and wealthier, and on balance, the North American continent is getting poorer and poorer.
We're talking to David Morgan on This Week in Money. A month ago, last time we talked, Dave, silver was at 29. It's been as low as 26 in the last month. Today, back up to 27. What is driving the silver market these days?
Well, always buying and selling, Phil, as you know, and the real problem, I think, is that the lower prices stay, the more the psychology starts to turn in favor of the shorts or the people that are forecasting lower silver prices. And unfortunately, it becomes a self-fulfilling prophecy after a while, because people that bought in at, 35, 32, 30 or whatever, 40, 45, it was there, a little more than a year ago, get disheartened after a year. And some will sell. They will just take the psychological hit. They can't stand it anymore, and they will sell back. And, of course, that adds selling pressure, which, of course, drives the price even lower. I really think that the bottom is in here. I could be wrong, but the sentiment is still very low. The low was 26.10. We're, well into the 27s. Mm-hmm. Gold has held roughly the 1550 levels on several tests. I think it's been tested enough times. So even though we're kind of walling around here near the lows, I think that we're going to be able to start building a base and start coming up. There's just too many problems out there in the global financial system for people that are awake and awakening, and as we've talked about earlier, concerned enough to actually take some action and buy some physical metal. But I think the bottom's in.
Gold and silver prices in the news this week. David, CIBC, one of Canada's largest banks, lowering its forecast for gold and silver prices. They say the Fed will probably not announce QE3 this year. They're calling for gold to finish the year at $1,700. That's down 6% from their previous forecast. And they're calling for silver to end up around $32.50. That's down from their previous target of $35. You think that's out of line? You think they're crazy to suggest this?
Well, I'm going to and probably not make a lot of friends with what I'm about to say, but it's never been my style to worry what people think about me. I think the QE3 thing is a bit overrated. I really think a lot of the gold bugs, and you can throw the silver bugs in with them, are anticipating some kind of QE3 announcement or a QE3 type of event that has a new name to it, and they think that's the spark that it's going to take, and it's really going to ignite the market again. I tend to disagree with that. Normally, markets forecast the future, and that means that a lot of the anticipation about a QE3 type of situation is probably built in now. What I don't necessarily agree with CIBC, I would have to admit that maybe this consolidation period is going to take longer than I think. I think that, the year and a few months we've had for silver and not quite the year that we've had for gold has probably been enough, but I could be wrong. Maybe it's going to take another 3 months, 6 months. I doubt it, but it could. Coming back to the bigger picture, though, they're wrong in my view, meaning that gold and silver are really the only competing currencies that they have in the system. And there's banking problems now. There are problems actually clearing in some of the member banks in the UK and some in Russia. So once there's these banking defaults or bank closures, and they're happening all the time, they just never make the mainstream news. More and more people are going to wake up, and they'll either take their money out of the bank or try to, or they'll move some of it into the precious metals. I mean, as I've said so many times, the precious metals are the only money that's outside the matrix. Everything else is either a counterparty risk of your bank, your broker, your transfer agent, or somebody that has to come up and close out the transaction, whereas if you hold physical metal, you're outside the system. And when things start to go the way that they're going, and I'm not trying to scare anybody, I'm just reporting facts here, you have something that you really cannot be touched other than by your own hands, and that's something that you really want in today's environment.
Interesting, David. The CIBC forecasting a stronger 2013 for gold and silver prices. Don't ask me how they can look this far out, but they're calling for $2,000 gold and $35 silver in 2013.
That's interesting because that's kind of where I think I said 2012, and I said this months ago, would be a transition year. And the transition is that the next group of people are, and hedge funds, I mean, when I say people, I mean, money managers, pension funds, individual investors, man on the street, is going to come to the conclusion by the end of this year that things are not going to get better, that the housing market isn't coming back, that the new jobs rate isn't going to increase, and things are going to be as they are or worse. And that's going to put a lot of fire in the bellies of a lot of people to start moving into the metals. And that's where I look for 2013 to be the year where we get the next leg up beginning. And I think continuing for several years, or, a couple of years at least, 2 to 3. So that's interesting that CIBC sees it. Now, their price forecasts and mine are a lot different. I'm looking for 2013 to see the old highs taken out in both the metals, and these are nominal highs, not inflation highs, because of the amount of inflation that we have had for so long. But you'll see gold well above the $1,900 level. They said 2,000. I'm looking for well above that by the end of 2013. Silver, the 48 level. Once that's taken out, it could go to 65, 75 quite easily. So I'm looking for like 65 to 75 in 2013 for silver, and probably a $2,500 level in gold by the end of the year. So we're talking roughly a year and a half from now. We're
talking to David Morgan on This Week in Money. Dave, last time we talked to you, said we have seen or are very near the bottom for gold stocks. We've had a great little pop since then. What's going on here now?
Well, that one I'm pretty confident in. Normally, as we talked about last time, the stocks precede the metals. And there isn't a real good cycle. I'm not a cycle theory guy. I believe in cycles, but it's not one of the areas I spend a lot of time studying. So I can't tell you what the average delta or change between the bottom of the metals stocks and then the bottom of the metals themselves is. Is it 1 month or 2 months on average or 3 months on average? I don't know. I doubt it's 6 months. So again, I think the bottom of the metals could be here already, and we won't know the bottom's in until, it actually happens and we've got enough data behind us that says, it really does look like the bottom. We're much higher than that now, and it's been climbing. That's the case for the mining equities. I think I called that one pretty well. I don't want to pat myself on the back.
Go ahead.
Well, I won't, because it's too early to know for sure, but boy, they are such a bargain. And we've been putting out stock recommendation after stock recommendation after stock recommendation. And some of these things, one of them is up 80% in this rotten market. And I don't, know of too many writers that have got that kind of performance in this kind of a crummy market. And that isn't saying that everything's come up. It hasn't. But nonetheless, we keep looking for true value in this market, and we keep doing recommendations. And why? Because now's the time to buy, people. You want to buy when you're scared. You want to buy when you think the market's going to go down. You want to buy when CIBC lowers their forecast for the precious metals. These are buying opportunities, not selling. Don't let the psychology scare you. I have that saying, I think I coined it, the market will scare you out or wear you out. We're in that situation now. A lot of people are getting worn out and giving up, and a lot of people are scared prices are going lower, so they won't buy. Get conviction. Get your conviction back. Know why you're buying these stocks. Know why you're buying these metals, and understand we win. Monetary history is very clear. Paper money always fails. Always fails. So, we're in that experiment one more time. Unfortunately, this one's a global experiment, which means a lot of people will be hurt. But you don't have to be. You can make your own conscious decision to get on the right side, which means precious metals and other commodities as well, and have a situation where you can actually do well during these very interesting times. What happens is most of the gold bugs are in, and a lot of them don't continue to buy. And a lot of them are in at, 500 average or 700 average or even $1,000 average price, and they see gold, at 1,600 or so, and even though they think it's going to, 2,000 or 3 or 5 or 10 or whatever their belief is, they're reluctant to buy here, or they have enough, I mean, you can't overload on gold. I mean, I actually have said that more than once. You really want, most people, probably 10% is enough. Some metalheads like me are much higher than that. But anyway, so there's got to be fresh buying, Phil. And that's what we're looking for, is fresh buying. And again, as we talked about, I think this is the year where that transition, where people start to wake up, where more people wake up and say, you know what, I've got to get some gold, I've got to get some silver. This thing isn't coming back. I got to look after myself. I got to quit worrying about it. I had this thought, I haven't ever expressed it on a radio show, Phil, but let me just digress a bit.
Sure, go ahead.
I learned this from a guy, and it makes me laugh, but it's also, I think, a lot of truth in it. He says, you're an adult when you know the cavalry isn't coming to the rescue. And that is a metaphor for what's going on.
Yeah.
Most of the governments on the planet have promised way too much for their people. And yet the only way that they can make those promises are on the backs of the people. So they make promises they can't keep, and they expect the people themselves to bail them out. Well, that's like pulling yourself up by your bootstraps. It cannot be done. So people that don't understand how the system works are really expecting the government to continue to provide goodies for them that cannot be provided. And this is where you got to get this attitude that I'm an adult. I got to take care of myself.
Yeah.
If the cavalry isn't coming to the rescue, mommy and daddy are gone. I have to take care of myself and start looking at your own personal responsibility.
David Morgan is our guest. You can find him at silver-investor.com, home of the Morgan Report. And don't forget, you can catch Dave on Twitter at SilverGuru22. Dave, always good to talk to you, and always fun. Thank you, sir.
Thank you, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
Ben Rabidoux is an analyst and strategist with M. Hansen Advisors, a market research firm that caters to professional institutional investors. Ben focuses on behavioral economics, consumer debt dynamics, and the role of housing in the Canadian economy. He is online at theeconomicanalyst.com. And you can also follow Ben on Twitter. Ben, thanks for posting that link to the YouTube video of the July 4 fireworks in San Diego. For folks who have not seen it, what happened?
Well, it was unbelievable. It just came across my Twitter feed. I thought it was kind of interesting. Just little glitch on July 4th in San Diego and the fireworks, and they had basically 20 minutes of fireworks go off in 20 seconds. It was kind of wild.
Wow,
Quite
pretty
a show
amazing.
for 20 seconds, but a bit of a letdown after that.
Kind of reminds me of the spectacular drop we had in real estate sales in Vancouver last month. A 27% drop in sales, but still, Ben, a buyer's market.
Well, yeah, I mean, I think more appropriately, it's a lack of buyer's market right now. I mean, there's just, people are starting to come to their senses, and, I think that what's happening on the demand front is, there's some anecdotes about some foreign investors starting to slow. We've chatted about that before. I'm still not convinced that that's the primary driver or has been the primary driver of the Vancouver market. I mean, I'm convinced it's a credit-driven speculative bubble. And if you really want to point the finger at something, I think that it's much, in clear causation. If you start looking at what came down in terms of mortgage guidelines and OSFI leaning on the banks to rein in some of their low ratio lending. So that's where somebody puts more than a 20% down payment. And you go back a couple months ago, and CMHC kind of said to the banks, listen, we're going to start rationing this insurance, where previously what could happen is the banks, if you came in, put 20% down, the banks could give you a mortgage, and then afterwards the banks themselves could purchase very cheaply aftermarket insurance from CMHC on that mortgage. It's called bulk portfolio insurance. And my own research has indicated that that's the loan segment here in Canada that was, I think, some of the worst underwriting. It's common sense. Look, if you're a bank and somebody brings in 20% down, you can do all sorts of silly things because you're not bound by CMHC guidelines. So you can waive income verification, which is what was happening, and you can, you don't have to check assets. All these things you can do because there's very little risk to you because you can buy bulk insurance aftermarket from CMHC. Now, when that suddenly evaporated, it's like sales died overnight. And there's a hilarious quote in the Globe. If you go back, so it's got to be almost a month now, and it was talking about how all these sales in Vancouver just suddenly died overnight. And it was an absolutely classic quote from a realtor saying, or maybe it was a mortgage broker, where they were saying all of a sudden the bank started checking income and assets, and they weren't making the loans. Go figure. I mean, if people are actually going to start checking income and assets, nobody's going to be able to afford these houses in Vancouver, and that's exactly what we're seeing. So, it's no wonder that Vancouver is dying right now, and I think it's got a long ways to go before it finds any sort of an equilibrium.
Interesting, Ben, that even though sales have dropped, the average home price in Vancouver up 3% from a year ago. To get this, $961,000 or 14 times the average income.
Yeah, okay. Average price up, or are we talking about the benchmark price?
This is the benchmark price.
Okay, well, okay. So what you have there, so there's a bit of, I think I'd rather wait and see what the TerraNet comes out with. The TerraNet's kind of a paired sale methodology. It's really the best measure of house price appreciation here in Canada, but I think the average price in Vancouver is actually going to be down something like 12 to 15% when the final numbers are released. And, some of that is changing sales composition. I mean, what's interesting right now in Vancouver is it's the high end of the market that's died first, right? West Side and single detached, all these places that used to be considered kind of the realm of the super rich. So that's kind of where sales have died and fallen the hardest. So that's very much in line with what you'd expect when all of a sudden the banks tighten up their lending on these super high mortgages. That's where I think you're starting to see sales declining there, and that kind of gets reflected in the overall average. So there's no way the prices are up. I'm sorry. That's just flat out spin from the real estate boards.
Great headline in the Vancouver Sun this morning talking about real estate. Ben says it's not a buyer's market until prices drop.
Yeah. Well, give that some time. The sales are low enough and inventory right now is high enough that, people are going to start pushing pretty hard. People who are, in fact, buying, and I don't know why they'd be doing that right now, but if you are buying, there's no reason you can't really turn the screws on some of the sellers. I thought it was interesting. I'm sure you saw it. There's a local Vancouver realtor who kind of came right out and just said, this is time to cash out, I think is what he actually said on his blog, and sold his own house. The writing's on the wall there. So, there's going to be some anxious sellers. So prices just won't be holding up for much longer.
Now, we're hearing all kinds of spin from the real estate people. And, of course, that's to be expected. They make a living selling homes. But here we are in Toronto. Sales down only 5% last month. That's according to the Toronto Real Estate Board.
Yeah. Now, if you actually dig deeper, so that's across the entire GTA and across all market segments. Now, you dig down a bit deeper, and if you look just at the City of Toronto, kind of the 416, sales are actually down about 13% for all property types, and interestingly, almost 20% for condos. Now, granted, last year was kind of the peak of the speculative mania in condos, and so you're comparing a very strong year to really what amounts to just a slightly below average year, but that decline is eye-popping nonetheless. Mm-hmm. And, I've said, I went back, it's been over a year ago now, and I said, look, the two markets that I'm most concerned about in Canada are number one, Vancouver, and number two, the Toronto condo market. And then after that, I think, is actually Montreal, which tends to fly under the radar, but there's some serious stress in that market that's going to start showing up in the stats. So yeah, it's no surprise that Vancouver condos are starting to sag, and year-over-year price increase, median condo prices in Toronto is up 2%. So I mean, that's less than inflation. So you give that a few more months, and I suspect that'll roll over.
Here's some spin for you, Ben, from Jason Mercer. He's a senior analyst for the TRAB. Says right now conditions remain tight, so we continue to report strong price growth. Yeah.
Now, he's actually right in a sense. I mean, if you look at the inventory numbers in Toronto, they are actually still remarkably low. And what we've seen in the last couple of months is quite a bit of new inventory coming onto the market, but the total existing inventory is actually quite low still. So he is right, and really what I think he's talking about in particular is the single-family detached segment, and that is still very strong. And I've said for a while, I think that there's quite a bit of gas left in that particular market segment. You may see prices rise for another 2 quarters in the detached segment, but I think ultimately these new CMHC rules are going to kind of take some of the wind out of that.
Especially important to separate condo sales from detached sales in Toronto. We're finding that out pretty quickly.
Yeah, very much so. Yeah.
Now, what's the difference between the volume in sales between the two?
Well, I think detached were more or less flat. I don't have the data in front of me, but I think that's about what it was. So year over year, about flat, and then condos were down quite a bit in the 416, and I think down moderately in kind of the rest of the GTA, 5 or 6% kind of rings a bell. But I've been watching that market pretty closely, and right now we got almost 54,000 residential dwellings under construction in Toronto, and about 46,000 of them are condos. So it's a ton of inventory in the pipeline. And if you look at who's actually buying these units pre-sale, most of them are not end users. Most of them are investors who are either planning on assigning those units before the building is completed, which is basically to say they sell their unit before it's completed, or they're planning on investing and sort of holding them as a rental. Now, you have such a high investor participation in that market, and yet those new condos, if you finance them traditionally with 20% down, they don't cash flow. Very few of them, especially in the 416, they will not cash flow. You get outside that, you may get a little bit of a cash flow on it, but I mean, you're talking of pretty paltry returns. So, I mean, let's call it what it is. That's speculation. Nobody buys an asset that doesn't keep up with inflation and you have to put money into every month unless you're absolutely convinced that you're going to be able to flip it for a profit at some point in the future. So you're banking on capital gains. So these are not investors. And when this market weakens, those are the people who are going to be exiting that market very quickly. And I think the people who are holding units, it's hard to say how much true speculation is going on, how many people are just holding units off the market just for capital gains. But whatever pure speculators there are out there, they'll come out of the woodworks pretty quickly, and that inventory will hit the market.
We're talking to Ben Rabidoux on This Week in Money. Finance Minister Jim Flaherty in the news again talking about his new mortgage rules. Says they could hurt the economy, but it's a risk worth taking. He says the greater risk, the development of a housing bubble. Is he kidding, Ben?
Oh, no, he's bang on. I mean, my thesis all along has been, if you really dig down at what's driving the economy in Canada right now, you can really boil it down to two things. It's real estate directly, so construction and real estate services. And then sort of a derivative of rising house prices is very strong consumer spending, right? And you see that it's called wealth effect spending. If you own a house and it's your largest asset and it goes up in value, you feel wealthier. You don't save as much for retirement because you feel wealthier. You may even access some of that equity and buy things you wouldn't otherwise buy. So all of that is part and parcel with very strong economic conditions. But when you dig below the surface, it's really being driven by credit. Right. And, he's absolutely right. When this whole speculative boom in the Canadian housing market returns back to more normal levels, it absolutely will be a major drag on the economy. But at this point, I mean, the government's caught between a rock and a hard place. It's going to happen. Like that's the point. Is at this point, you just cannot engineer, I don't believe, a soft landing without without severely impacting the economy. So the only other option is you kind of kick the can down the road until ultimately you wind up with a major financial crisis. So I support his moves. It will hurt the economy. He knows that. But at this point, what do you do?
I ask if he's kidding because I'm wondering if he knows that we're already in a housing bubble.
Oh, I have no doubt he does.
Yeah.
I have no doubt he does. In fact, I've even sent him some of my reports and gotten a few comments. He's certainly seen my perspective. Whether that sways him at all, I don't know. But it's pretty hard to miss it when you're looking at the granular data. So I think he's concerned. Interestingly, just this morning, there's kind of an announcement about credit unions and how they now have the option to become federally regulated. And I think that's another sign that the feds are getting concerned with underwriting here in Canada. Because you got to remember, these credit unions are provincially regulated, right? And we've seen now, so the chief financial regulator here in Canada is the Office of the Superintendent of Financial Institutions, OSFI, and they've done quite a number on bank lending in terms of reining it in the last few months. Very obvious that they're concerned about what's happening at the banks. Now, they do not have jurisdiction over the credit unions, and some of these credit unions are enormous. If you look at some of the insured deposits, so remember, the provinces insure the deposits at the credit unions. The federal government insures deposits at the banks. Okay. So this is really a provincial liability. But if you look at the amount of insured deposits at credit unions in places like BC and Quebec, it's 25% of provincial GDP. So it's enormous. Wow. So I have no doubt that the feds want to rein in what's happening at the credit unions and have more say over some of the lending guidelines there. So I see this announcement: hey, you can become federally regulated. You can jump from province to province much easier, but the kind of catch is that we now regulate your lending, right? And it just seems to me that it's one more sign that the feds recognize that there are problems in our lending here in Canada.
Ben Rabidoux is an analyst and strategist with M. Hansen Advisors. He's online at theeconomicanalyst.com. And you can also follow him on Twitter, where you can see fireworks and stuff like that. That's excellent. Hey, thank you, Ben. Good to talk to you again.
Yeah, my pleasure. Thanks very much.
This Week in Money is archived online at talkdigitalnetwork.com.
Ellen Brown is an attorney and president of the Public Banking Institute. She's also author of The Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. The 2012 edition of Web of Debt is out, and it's also available as a PDF and Kindle version, and it's also available in German, Swedish, Spanish, and Korean. Ellen, people are starting to get the message, apparently.
Yeah, actually, it's being translated into Chinese now.
How fabulous. Well, they probably need it there more than ever, and we can find out more information at webofdebt.com. It's good to have you back on This Week in Money.
Oh, thanks, Phil.
You are talking to us from Switzerland today. You're on your way to Croatia. What's going on there?
There's a conference in Croatia called the Tesla Conference. It's largely on the global exchange. Well, the supporters of the conference are. Their thing is that we should use, instead of a global reserve currency, the dollar, we should be using green energy as not as a currency, but as a standard of value for measuring currencies. I don't necessarily agree with that, but it's an interesting proposition. And they asked me to speak on public banking, which, of course, is my specialty. But I will propose what I think might be a good solution for the international problem as well.
Interest rates in the news this week, Ellen. The European Central Bank lowering interest rates to all-time lows. And here's ECB President Mario Draghi taking a page out of the Bernanke playbook. Says the ECB has more tools at its disposal if the economy should falter.
Well, the problem with the ECB, they are lending to banks. So they were lending at 1% to banks, and the Federal Reserve, the Fed funds rate for banks in the U.S. is 0.25%. So sure, they could lower it by 3/4, and they'd be down to where the Federal Reserve is. But that does not help the countries that are the ones that are desperately struggling for money. They have to get their money on the private market, which means the bond market, which means they're subject to the whims of the rating agencies and the speculators, the short sellers. So here are the banks borrowing from the ECB at 1%, which should have been the central bank for all those 17 countries. And Greece, for example, recently was borrowing at 30%. Well, that's a killer. At 30%, your debt doubles in something like 3 years. I mean, there's no way they can sustain that sort of debt. And it's not because of the debt. It's because of the interest rate. So the ECB should lend directly to the countries. They don't because there's a rule against it, but they should change the rule. All the whole EU is a set of rules.
Ellen, a lot of us are familiar with the European Central Bank, not so many with the European Stability Mechanism. And over at commondreams.org, you are writing about Europe's shock doctrine. Government by the banks, for the banks. You're saying it's an ESM coup d'etat in Europe. Tell us what's going on here.
Well, this is a fund that is replacing certain temporary funds that were the equivalent of our TARP fund, which bailed out our big banks. And in the U.S., Congress approved $700 billion for TARP, and that was it. They didn't approve any more. But this ESM is an open-ended fund. It's permanent. The countries, meaning the taxpayers, are on the hook for it. And even though they're starting out at 700 billion euros for no known reason, maybe they're just modeling it after what the banks got away with in the U.S., but there's no limit. It can be raised. The people in charge can't be taken to court. There's really no control over the technocrats that will be running this fund. And recently, on June 29th, Angela Merkel was made to concede the point that the banks would be able to get money directly. Faltering banks could get money directly from this fund. So that puts the taxpayers on the hook to bail out private banks all across the Eurozone. So it's basically just welfare for the rich, as they say. It's a permanent bailout mechanism for private banks, and it's the taxpayers. It's not even the ECB, which has the power to print money on its books, but the taxpayers who have to come up with their own hard-earned cash to bail out these banks.
Now, you talk about a coup d'etat. One of the main actors in this little play is Italian Prime Minister Mario Monti, who we have forgotten already wasn't actually elected. He's not really a politician. He's a technocrat.
Right. He's a banker. He came from Goldman Sachs, and he's also a leader in the Trilateral Commission and the Bilderberger Group. And their whole thing is sort of globalization, one world government, one world currency. And, if you read all their shocking literature, there various times they've said things like, you need a crisis in order to get countries to agree to this sort of thing. So it looks like they have a manufactured crisis here, a debt crisis. Everybody's in debt. And in desperation, worried about their money in their banks, they make all these concessions and agree that the private banks can, in perpetuity, be bailed out by the taxpayers.
The interesting thing here is that we're talking about the European Stability Mechanism like it's something they can use tomorrow, but only 4 of the 17 European countries have actually ratified the ESM.
Well, that was true as of, I think, 2 weeks ago, but Germany did ratify it, and the goal was to have them all ratify it on July 1st, and that's why there's all this. It was a EU summit on Thursday, the 28th, that lasted well into the night, and Mario Monti and the Prime Minister of Spain made a big ruckus and said they were going to block everything if they didn't get their way, and what they wanted was easier terms for getting the bailout money and for the banks to be bailed out directly instead of the money going to the countries, and then the countries would bail out their own banks.
Ellen, let's look at some of the other actors in this play, the Trilateral Commission. Who are they and what do they do?
The Trilateral Commission was set up by David Rockefeller and it's a big new Brzezinski. They were aiming for basically globalization, or in Europe, the idea would be to have all those European countries get together and have a single government, a single currency. And David Rockefeller said in his book, The Grand Chessboard, that we would need some sort of catalyzing event in order to bring this about, because otherwise the countries wouldn't agree on their own. And David Rockefeller said in his biography, his autobiography, he said, some people say that that he was part of a secret cabal that was aiming at one world government and globalization. And he said, if that is the charge, I admit to it, and I'm proud of it.
What about the Bilderberg Group? Who are these people?
I think they started in something like the 1950s, and it was just, again, it was a secret meeting of financiers and politicians. Their thing was the one world company. I remember there was this man named Ball who was a U.S. statesman, and he said we would have one world company where instead of governments being in charge, it would be a private cartel, basically owned by bankers and big financiers, and they do that by leverage buyouts, etc. So they've been at this for at least 70 years. In 1973, after the dollar collapsed, after it went off the gold standard, in 1971, they got together and decided to back the dollar with oil. So now the dollar's backed by guns and oil, but that's the sort of thing that they plot and plan. Of course, they don't publicize what they do, but there are reporters that manage to get in and report.
Okay, so we know who the main players are. Where do we go from here, specifically in Europe, Ellen?
I think what they should do is that the governments should issue their own currencies. I mean, they could keep the euro as a clearing mechanism between countries, sort of a international currency. But in their own countries, they need more money. The EU is just short of money. They only allow a limited amount of euros. Nobody can print them except the ECB, and the ECB is not doing it for the benefit of the people. So they're just short of cash. So how are they going to run their economies? They have to lay off workers and privatize everything, which is obviously the goal of these technocrats who are trying to get the privatization of everything, and they want governments to lose the ability to create their own money. But if, say, Greece could go back to issuing its own drachmas, and then with the drachmas, it could hire back all those people that have been laid off, it could get the economy going again. There's always the concern that it would quickly be devalued. But if you didn't make it, you could put in exchange controls and capital controls and all those things that have been done historically, like Malaysia did that to protect their currency in 1998 when we had that Asian crisis. So there are things that can be done. That's what I think they have to do. They have to expand the currency somehow.
We're talking to Ellen Brown from webofdebt.com here on This Week in Money. And we've all been enjoying the Jamie Dimon show over the last couple of weeks. Unbelievable. You have a great piece on your blog, Why the Senate Won't Touch Jamie Dimon. And the good reason is a great one. Maybe it's all those derivatives that J.P. Morgan controls. $57 trillion in interest rate swaps.
Right, and the question is, who is the counterparty on these swaps? There's nobody big enough, according to, this is an article by Rob Kirby, and it was picked up by Jim Willey. There's nobody big enough except the U.S. Treasury, probably through this exchange stabilization fund that is set up supposedly to maintain the value of the currency. But what that means is protecting the dollar. Well, if U.S. bonds went to 30% the way the Greek bonds did, of course that would destroy the dollar. It would no longer be the reserve currency. So how are they keeping the U.S. interest rates so incredibly low on their bonds when the U.S. is as much as in debt as many other countries that have horrible interest rates? There are two possible explanations for this. One is that they're propping it up with these interest rate swaps, and another is that the Federal Reserve actually buys up any leftover bonds, so that the Treasury just sets the interest rate and says we're going to issue X series of securities at Y interest rate, and then any that don't get bought up are bought by the Federal Reserve, and then the Fed rebates the interest to the government, and of course the Fed gets the money just by printing it on its books. And they're doing that openly, blatantly, and they're calling it quantitative easing. So there are those two factors going on. But if they do that too blatantly, the Chinese aren't going to be pleased. You know, they've got, $1 trillion at least in dollar reserves. So So we could be in trouble internationally if we just too blatantly print our own money. So the interest rate swaps are very handy to just keep the interest rate where they want it.
Ellen, assuming that the U.S. Treasury is the largest counterparty to this, almost $60 trillion in swaps, what's the downside here? What could go wrong?
Well, we just saw that J.P. Morgan made a very bad bet that it started out at $2 billion, and that's what Jamie Dimon was there at the Senate being called on the carpet, supposedly, although actually they sort of put out the red carpet for him. But he was supposed to be explaining this $2 billion, and then it was $3 billion, and now we've heard it may be as high as $9 billion, and Jim Willey thinks it's higher than that. So the thing is that we don't know what's going on behind. If they can lose that much money miscalculating on one of these derivatives bets, which is just supposed to be a hedge, but it obviously wasn't. It was obviously a speculative bet, which is illegal. If they can lose that much money on that, how do we know what's going on with this other $57 trillion? They need transparency and investigation.
Tell us what you would change.
Well, I think that they should make derivatives illegal. They used to be illegal. And our former Fed chairman, Alan Greenspan, in the 90s decided they were a good idea because the banks were losing their market share. And, I mean, imagine a whole industry that gets their rights protected or gets their market share protected by changing legislation. But that's how powerful the banks are. They said they were losing market share to these private things like mutual funds. So they were allowed to gamble in derivatives, and then the Glass-Steagall Act was removed, which separated investment banking from commercial banking. So all these things were allowed just to serve the banks. Well, it's not serving us, and all their bluster is saying that it is. We've seen now that it's not true. Obviously, their model's wrong, and so we've got to change the whole system. But then the question is, how do you unwind these things? There's always the fear that it's like you pull... It's all this whole house of cards, and you pull a few cards out, and the whole thing's going to collapse. So we don't know what great destruction would come from that. But somebody knows, and they need to investigate that, and they need to. If they're just bets, you can just call off the bet and say, "All right, neither of you has an asset here. Just write that off your books." And in terms of propping up the interest rate, I think that the Federal Reserve should be buying the government's debt. They shouldn't have been selling it privately in the first place. Canada funded its debt through its own Bank of Canada from 1939 to 1974 for 35 years, essentially interest-free because they owned the bank, and it worked brilliantly well. And Canada funded all sorts of seaways and roadways and an excellent healthcare system, which we haven't managed to implement. They did all that by borrowing from their own central bank. We should do the same thing just openly and say, that's what we're going to do. Everybody freaks out and said this will be inflationary, but it wasn't. And we have the evidence of history. It's been done many times, and it's not inflationary. It all depends on what you spend the money for, of course, but if you put that money into productive things, like Brazil did it, they used their development bank, the BNDES, and put the money into everything in sight that was developmental, productive things, no speculation, no derivatives, only things that produce things for the economy. And they just took off. They totally turned their economy around. This is under President Lula. In the 1990s, Brazil was the world's largest debtor, and 10 years later, they were making loans to the IMF. They had totally turned their economy around, and they did it by taking their big development bank, which is a public bank, and using it for public purposes, pumping money into the economy.
Ellen Brown is author of The Web of Debt, The Shocking Truth About Our Money System and How We Can Break Free. You can find out more at webofdebt.com. Ellen, thanks for being on with us.
Thank you, Phil.
Thanks to our guests, David Morgan, Ben Rabidoux, and Ellen Brown. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.